Okay, we are diving deep into what has been a wild week in finance. Seriously, we've got a really fascinating mix to unpack this time. Big market milestones to hit, expert opinions, some from some pretty familiar faces making some interesting moves, to say the least. Oh, and even a little corporate drama sprinkled in because, well, why not?
It's a pretty eclectic mix of sources, that's for sure. But hey, it all adds up to a pretty good snapshot of the overall market temperature as we, head into the last few months of the year here.
And that temperature right now, well, the S&P 500 is practically on fire, smashing past 5,800 to close at a record-breaking 5,815. Which, of course, begs the question, is 6,000 even a question anymore? Or is this market exuberance going to, come crashing down around us?
What I find interesting isn't just the new record, but what's fueling it. We've been on this upward trend for a while now, and some analysts seem pretty convinced it's got some serious legs, like marathon, not a sprint, kind of legs. They're even saying those dips everyone's bracing for, the ones that usually send investors running for cover, those might actually be the perfect buying opportunity.
So instead of dreading a downturn, some investors are rubbing their hands together, eager to jump in. That's wild. And it's not just the S&P feeling bullish either, right? The Nasdaq has been putting together a pretty impressive string of gains lately, too. Could it be gearing up to reclaim its own all-time high from, well, back in the day?
It's definitely within the realm of possibility, but history has a funny way of, well, repeating itself. Remember the dot-com bubble? Yeah, sometimes those good times, they don't last forever, no matter how much we want them to.
You're preaching to the choir. It's easy to get caught up in the excitement, but those cautionary tales, well, they're cautionary for a reason. But let's shift gears a bit, move away from the celebratory atmosphere for a second, and talk about something that usually makes investors a little, shall we say, nervous.
Yeah.
Inflation. We got some key CPI and PPI data out this week, and those numbers, well, let's just say they tend to dictate the market mood, right?
Oh, absolutely. And this time around, that data is painting a bit of a mixed picture. See, CPI in September, it actually ticked up slightly, both overall and when you factor out those volatile food and energy prices, so-called core CPI.
So not exactly a return to, pre-inflation days, but not the runaway train some folks were fearing either.
That's a good way to put it. The Federal Reserve, they'll be dissecting this data pretty intensely as they get ready for their big interest rate decision coming up.
Which has, everyone on Wall Street holding their breath, let's be honest. But before we dive into the whole interest rate debate, let's talk about a banking giant that's been making headlines both for its, let's call it success, and a bit of a stumble this week. JPMorgan Chase.
Yeah, they definitely kicked off earnings season with a bang, I'll give them that. Surpassed revenue expectations, beat profit forecasts, the whole shebang.
Sounds like a clear win for JPMorgan. So where's the but coming?
Well, their CEO, Jamie Dimon, the guy who's practically famous for his cautious outlook, some might even say he's prone to a bit of, well, worrying.
Okay, I think I see where this is going.
Right. Well, he threw some pretty significant cold water on the whole victory lap. And this is where it's important to understand the context of Diamond's past warnings. He's been waving red flags about potential market instability for a while now, and his track record suggests it's usually a good idea to, at least listen when he talks.
So not just a case of a CEO being pessimistic for fun.
Exactly. And this time, he even pulled out the big guns, vocabulary-wise, used the term black swan when discussing the current global landscape.
Okay, so we're not just talking about your average market dip here.
Not exactly. He's talking about those unpredictable, almost impossible to foresee events that can really throw the whole system out of whack. And given his, insights and influence, I don't think investors should take those words lightly.
No, I don't think anyone will be taking those words lightly. And speaking of influential figures in finance, well, we can't forget about good old Warren Buffett. The man practically sets off seismic waves with a single stock purchase. And this week, well, let's just say he's been busy.
He certainly has. Berkshire Hathaway, Buffett's company, right?
Yeah.
Well, they've been, shall we say, strategically reducing their stake in Bank of America.
Strategically? Come on, spill the tea. What's the Oracle of Omaha, as they call him, up to? Is this a sign that he's sensing a storm brewing in the banking sector? Or is there, a totally different game at play here?
See, to really understand Buffett's strategy, you got to look beyond just the surface level, right? This is a guy who's famous for anticipating major market shifts years in advance. So this Bank of America move, it could be a strategic realignment, sure, or maybe a reaction to something he's seeing in their upcoming earnings report, who knows? Or maybe he's just diversifying.
It's a good reminder that even with figures as, prominent and closely watched as Buffett, there's always more to the story than meets the eye. Now, while we're on the topic of banks, let's shift our focus north of the border for a bit, to Canada, where TD Bank, well, they found themselves in a bit of hot water this week.
Hot water might be putting it mildly. A $3 billion fine for, get this, failing to prevent money laundering. Not exactly a great look for a banking giant.
And I'm guessing their stock didn't exactly do a celebratory dance after that news broke.
You can say that again. Took a pretty big tumble.
Yeah.
But here's where things get kind of interesting. TD, they had already accounted for this fine. Like, they had funds set aside, so financially speaking, they were prepared.
Okay, so if they already had the money stashed away, what's the big deal?
Because they might have been ready for the financial hit, but what you can't really put a price tag on is the potential damage to their reputation, and the long-term consequences that come with that kind of scandal.
So it's not just about the money, is it?
Exactly. We're talking stricter regulations, potential limitations on their operations, and maybe the biggest one, a hit to investor confidence. Those are things that are a lot harder to bounce back from than a fine, even a hefty one.
It's a good reminder that in the financial world, your reputation, that trust factor, it's just as valuable, maybe even more so, than how much money you have in the bank, so to speak. And speaking of companies known for pushing boundaries and making headlines, we got to talk about Tesla, their big robot event, the one that was supposed to, change the world. Well, let's just say it didn't quite live up to the hype.
Yeah, highly anticipated might be a better way to put it. I mean, don't get me wrong, the unveiling of their Cybertruck visually, it was impressive, sure, but it left investors with more questions than answers, like no steering wheel, no pedals, and the production timeline. Let's just say it felt a little more concept car than available next fall.
And their stock took a hit because of it. Not exactly surprising.
Nope. Down 8.78% after the event. I guess it goes to show that even Elon Musk, Mr. Innovation himself, can't completely defy the realities of hardware development.
Building a robot is a tad more complex than writing code, wouldn't you say?
Just a tad. But it brings up a really important point, this fundamental difference between software companies and hardware companies. Software, it's all about scalability. You can add like 1 million users to a platform practically overnight without your costs going up that much. But hardware, well, it involves physical production, supply chains, actually making a thing.
So when you're looking at a tech company as an investment, it's not just about how cool their latest gadget is.
Exactly. Gotta look beyond the shiny new object and really understand the underlying business model, right? How does this company actually make money? How scalable is their product or service? What are the potential roadblocks they're going to hit as they try to grow? Those are the questions investors should be asking.
It's about separating the companies that are, built for that long-term success, the ones that have staying power, from the ones that might be here today, gone tomorrow. Makes you wonder, though, right? Like, who actually benefits from Tesla's robot dreams getting, delayed?
That's a really good point, actually. And you know what? The answer might surprise you. The most immediate beneficiary, probably Uber.
Uber? Really?
Yeah.
I mean, they're all about ride-sharing, not building robots. Last I checked, anyway.
True, but think about it. One of the biggest concerns around all this self-driving tech, right, is what happens to the drivers. Like, if robo-taxis were suddenly everywhere, what happens to the millions of people who drive for Uber and Lyft and all those companies?
Ah, okay, I see what you're saying. So with Tesla's robot timeline, pushed back a bit, it buys Uber some breathing room.
Exactly. Time to adapt, maybe explore some partnerships, even develop their own autonomous vehicle stuff, but without this, looming threat of a robot workforce just showing up and potentially, disrupting their whole business model overnight.
Wow, yeah. It's a good example of how one company's, let's call it a setback, can create a golden opportunity for another. But hey, let's zoom out for a second, move away from the world of self-driving cars and robots for a bit. I want to go back to that fundamental difference between software companies and hardware companies. We touched on it earlier, but what does that distinction really mean for the average investor who's just trying to wrap their head around the tech landscape?
That's the million-dollar question, right? So software companies, as we talked about, they've got this potential for explosive growth without their costs necessarily exploding alongside it. It's all about scale. They can add users like crazy without having to build a new factory every time someone signs up. Think about a company like Spotify. Millions of people can be streaming music at the same time, and Spotify doesn't have to make any physical changes to accommodate that.
Right, it's all digital, those ones and zeros, like you said.
Exactly. But hardware companies, while they're capable of amazing innovation, don't get me wrong, they often face more limitations. They're dealing with physical manufacturing, supply chains, the costs associated with producing each individual unit. It's a different ballgame. Take Apple, for example. Every time they release a new iPhone, well, that requires raw materials, factories, this whole intricate global supply chain.
So when you're evaluating a tech company as a potential investment, it's about more than just, how cool their latest gadget is or how flashy their marketing campaign is.
100%. You got to look beyond the hype, beyond the surface, and understand how the sausage is made, so to speak. How does this company actually make money? How scalable is their product or service, really? What are the potential roadblocks they might hit as they try to grow? Those are the key questions.
It's about separating those companies that are built to last, the ones with that long-term potential, from the flash-in-the-pan kind of companies,
Yeah.
right? The ones that might be here today, gone tomorrow.
Exactly. And speaking of companies facing some, shall we say, challenges, let's circle back to TD Bank for a sec. That massive $3 billion fine they got hit with? Yeah, there's more to that story than meets the eye.
Okay, so we talked about how the fine itself, while huge, was something they had already accounted for, financially speaking. What has investors spooked then? What's the real concern here?
The real concern, the thing everyone's watching closely, is the potential for asset growth restrictions. See, these restrictions, they could limit TD's ability to do things like expand their loan portfolio, invest in new ventures, basically grow their business.
So it's like telling a company, hey, you can only sell a certain number of widgets each year. Puts a hard cap on their earning potential.
That's a good analogy. And that kind of uncertainty, well, it makes investors nervous, rightfully so. Because if a company can't grow, well, their stock value is probably going to stagnate, maybe even go down. Not exactly what investors are looking for.
So is TD Bank a risky investment right now? Should people be steering clear? What's the verdict?
It's not a simple yes or no answer, unfortunately. Like most things in finance, it's complicated. There are a few factors to consider. First, the reports coming out suggest that these potential restrictions, they might be limited to TD's U.S. operations, which would obviously soften the blow significantly. I mean, they do a ton of business in Canada.
Okay, so that's a potential positive. What else should investors be keeping in mind as they, try to make sense of all this?
Well, even with all this drama swirling around, TD Bank, they still have a very attractive dividend yield, over 5%, which is nothing to sneeze at. And with Canada, they're expected to potentially cut interest rates even further. Deposit rates are likely to fall well below that 5% mark. So for income-seeking investors, TD Bank might still look pretty tempting, especially after their stock price took a bit of a dip.
So it's a classic case of risk versus reward, high potential upside, but also some things that could go wrong.
Exactly. My advice: do your research, look at their track record, and make an informed decision that aligns with your own investment goals and, of course, your own personal risk tolerance.
Solid advice, as always. Now, before we move on from the world of banking entirely, I want to circle back to Warren Buffett for a sec, specifically his decision to, let's call it trim the fat on his Bank of America holdings. It seems like every time this man makes a move, the entire financial world goes into a frenzy trying to decode it, like it's some ancient prophecy or something.
Well, he has earned that reputation as a shrewd investor, that's for sure. But here's the thing to remember about Buffett. He's playing the long game. Always has been. His strategy often involves anticipating challenges and mitigating risk, like years in advance.
So should we all be panicking and selling off our bank stocks just because Buffett is?
Probably not. It's important to remember that Buffett's moves aren't always like a crystal ball for the entire market. I mean, remember when he sold off a bunch of Apple stock a while back? Look at Apple now. They've been on a tear.
True, true. So how should we be interpreting this Bank of America move then, if it's not necessarily a sign that the sky is falling?
It's best to view it as just one data point among many. It's worth noting, too, that he's been slowly reducing his stake in Bank of America for a while now. This isn't like a sudden, impulsive decision. It's more of a continuation of a long-term strategy.
So maybe he's rebalancing his portfolio. Or maybe he just sees more attractive opportunities somewhere else. It's not necessarily a sign that the entire banking sector is about to, go belly up.
Exactly. But it does highlight a certain level of caution that even the most seasoned investors are feeling right now, which, hey, that's always worth paying attention to, don't you think?
For sure. And on that note of caution, let's shift gears back to those all-important inflation figures, the ones that have been keeping economists and investors up at night. Inflation, as we all know, has this way of impacting, well, everything. Consumer spending, corporate profits, and, of course, interest rates.
It's the puppet master of the economy, some might say. And in this case, the CPI and PPI data we got this week, well, it suggests that inflation, it's still a concern, but it seems like it might be easing up a bit, which is a good thing.
So not quite back to those pre-inflation days of yore, but not the runaway inflation nightmare some folks were bracing for either.
That's a good way to put it. And, the Federal Reserve, they'll be poring over these numbers like they're sacred texts as they get ready for their next interest rate decision, which, if I'm not mistaken, is coming up pretty quickly.
Yeah, and that decision has a lot of people feeling, well, let's just say anxious is a good word for it. So what's the general consensus right now? Are we going to see a rate cut, or will the Fed decide to, pump the brakes?
Well, if you're asking me to read the tea leaves a bit, based on the current data and the overall market sentiment, I'd say a small rate cut in November is looking pretty likely. But, and this is a big but, don't expect anything dramatic, no fireworks this time, I'd say. The Fed's probably going to take a more measured approach here, carefully weighing the potential ripple effects of their decision, both on inflation and the economy as a whole.
It's a tough job, right? Trying to find that sweet spot. They want to support economic growth, but not let inflation run wild. It's a delicate balancing act, to say the least. It'll be interesting to see how it all plays out. It's a lot to process, that's for sure. But hey, that's why we do these deep dives, right? To try and make sense of it all. So as we wrap things up here, let's leave everyone with something to, chew on over the weekend. We spent a good chunk of time talking about the differences between software companies and hardware companies, how one is all about that digital scalability, while the other is, well, a bit more grounded in the physical world. But how can you, as an investor, actually use that insight to make smarter decisions? Like, what's a practical application here?
It all comes down to looking beyond the product itself, the shiny new object, and really understanding the mechanics of growth. Imagine everything goes perfectly according to plan for a company you're considering. What does their path to large-scale success actually look like? Is it a smooth upward trajectory, that kind of hockey stick growth we hear so much about, driven by widespread adoption of their software? Or are they going to be facing some serious speed bumps along the way because they're dealing with, factories, supply chains, the complexities of actually making a physical thing?
So it's not just about picking what you think is going to be the next thing. It's about understanding what actually fuels sustainable growth over the long haul, especially in a field as, well, constantly evolving as the tech world.
Exactly. You got to be able to look beyond the headlines, the hype, all of that, and really dissect how the business model works. And then, of course, ask yourself, does that align with my own personal investment goals? And how much risk am I really comfortable with?
It's about making smart, informed decisions, not just getting swept up in the excitement, right?
Yeah.
Which is easy to do, by the way.
Easier said than done sometime.
For sure. But hey, knowledge is power, right?
Mm.
Well, on that note, I think we'll wrap up this whirlwind tour of the markets. We covered record highs, some unexpected struggles, and of course, those all-important economic indicators that always seem to keep everyone guessing.
Until next time, stay curious. Keep asking those tough questions. And remember, in the world of finance, knowledge is your most valuable asset.